Have you ever wondered about the current state of the market and its fluctuations? It's a question that sparks curiosity, isn't it? Well, that's what we're here for. In this vast ocean of financial waves, understanding the ebb and flow is paramount. This week has been a roller coaster ride, with events that have shaped and reshaped the market's course. We've seen the Federal Reserve, often referred to as the Fed, adopt a hawkish stance, signaling that they may raise interest rates sooner than we thought. Meanwhile, crude prices have soared, creating a ripple effect across various sectors. And then there's the fill selling, a heavy downpour that has left its mark. These events are not just headlines, they are the undercurrents that steer the market's direction. They are the reasons behind the rise and fall of your investments, the profit and loss statements, the portfolio balance sheets. In the next few minutes, we will delve into these events and analyze their impact on the market. Starting our week on Monday, the Federal Reserve signaled a hawkish stance. Now, what does this mean? In simple terms, a hawkish stance implies that the Federal Reserve is leaning towards tightening monetary policy, often through interest rate hikes or reducing the money supply. This is usually done to curb inflation or overheating in the economy. This week, the Fed's signal wasn't just a gentle nudge, it was a clear and decisive message, indicating that they are ready to take necessary action to maintain economic stability. This action can include tightening monetary policy sooner than expected, a move that can have significant implications for businesses, investors, and the economy as a whole. So how did the market react? Well, as you can imagine, the market's response was swift. Investors began to reassess their positions, leading to a shift in the market dynamics. The ripple effect of this hawkish signal was felt throughout the week, influencing investment decisions and market movements. These signals have set a tone for the market for the rest of the week. Fast forward to Wednesday, crude prices took a sharp upward turn. The market saw a sudden surge in crude prices, an unexpected twist in the week's tale. The primary catalyst for this hike? A multitude of factors. Increased global demand, geopolitical tensions, and reduced supplies all played a part in this dramatic upswing. The energy market, always susceptible to the slightest tremors of change, reacted as expected. Oil stocks experienced a burst of vitality, while industries heavily reliant on crude oil for their operations felt the sting of increased costs. Investors, always on their toes, had to adapt quickly. Those holding onto oil stocks saw their portfolios swell, while others had to navigate the choppy waters of increasing operational costs and dwindling profit margins. The implications of these soaring crude prices extend beyond the immediate. They have the potential to influence inflation rates, disrupt global economic recovery, and even shape future policy decisions. The soaring crude prices have added another layer of complexity to the market dynamics. As we reach the end of the week, Friday brought about heavy fill selling. Now let's delve into the world of fill. For those who might not be familiar, fill, short for Filecoin, is a decentralized storage system aiming to store humanity's most important information. It's been making waves in the digital market, but this Friday, we witnessed a significant surge in fill selling. So, what led to this? Well, there are a few factors to consider. Firstly, the overall bearish sentiment in the crypto market played a key role. As we've seen, when the tide turns in the crypto world, it can pull even the strongest swimmers with it. With worries over regulatory crackdowns and tighter monetary policies looming, investors started to pull back, leading to an increase in fill selling. Secondly, the lack of momentum in the fill market itself added fuel to the fire. Despite its promising technology and robust network, fill has been struggling to maintain its momentum. This lack of upward movement can often lead to investors deciding to cut their losses and sell, contributing to the heavy fill selling we saw. Now, how has this influenced the market? As with any significant selling pressure, the heavy fill selling has had a ripple effect on the crypto market. It has led to increased volatility and uncertainty, with investors questioning the stability of not just fill, but the broader crypto market as well. This in turn has had a knock-on effect on the overall sentiment in the market, causing many to adopt a more cautious stance. It's important to remember that in the world of investing, sentiment can often drive the market just as much as, if not more than, the fundamentals. So, what's the takeaway from all this? Well, it's clear that the heavy fill selling has added another layer of complexity to an already tumultuous week in the market. As investors, it's crucial to stay informed and be prepared for these kinds of shifts in the market dynamics. This heavy selling marked a significant end to a tumultuous week in the market. So, what does this week of profit booking mean for the market? In the grand scheme of things, a week may not seem like a lot, but in the world of finance it can be a lifetime. The past week has seen a flurry of activity, with investors booking profits left, right, and center. This has been driven by a combination of factors including signals from the hawkish Federal Reserve, soaring crude oil prices, and heavy fill selling. Let's break it down a bit. The Federal Reserve, with its hawkish stance, has sent ripples across the market. This has prompted investors to reassess their positions and book profits where they can. This, in turn, has led to a sell-off in the market, leading to a dip in prices. Then, we have the crude oil prices. The soaring prices have caused a ripple effect across various sectors. Companies reliant on oil for their operations have seen their costs go up, squeezing their margins and leading to a drop in their stock prices. This has triggered a wave of profit booking as investors try to minimize their losses. And finally, the heavy fill selling. This has been the most significant contributor to the week's profit booking. The sell-off in fill has been nothing short of a landslide, causing a domino effect across the market. Investors, fearing further losses, have been quick to book profits, leading to a further drop in prices. All these factors combined have created a perfect storm for profit booking. But what does this mean for the future? Well, it's a bit of a mixed bag. On the one hand, the sell-off could be a sign of a healthy market correction. On the other, it could also be indicative of a more prolonged downturn. So, as we navigate these choppy waters, it's crucial to keep a keen eye on the market trends and developments. Understanding these market fluctuations can provide valuable insights for investors and market enthusiasts alike. As we wrap up, remember that understanding these market fluctuations can provide valuable insights for investors and market enthusiasts alike.